So we had the big 50 basis point Fed rate cut. They hit the panic button. What comes next? Well, I'm going to do my best to try to lay that out here in this video, and obviously there's no promises or guarantees. All we can do is look at the information we have right now and kind of guess what comes next. But I think it's safe to say it's probably not going to be good. Now here's something interesting. Like we talked about a couple of days ago, if they would have only done a 25 basis point rate cut, then the stock market would have freaked out and probably had a little mini crash. So they were essentially expecting a 50 basis point rate cut, and since the Fed pretty much does whatever the stock market wants them to do, then they kind of caved in and did the 50 basis point rate cut. And of course, that was what they were hoping for, and the market shot up. But now that the euphoria is over, and a lot of investors are now sitting there worried, why did they cut by 50 basis points if Jerome Powell kept saying in the press conference that everything looks great and there's literally no indication of a recession? That's what he said, guys. Like, he says, I see nothing that indicates that we are going into a recession and that everything in the economy looks very strong right now. That's what he says. He also said that the labor market is strong right now, so the Fed doesn't seem to be concerned that it's behind the curve when it comes to dealing with maximum employment, because obviously unemployment has been on the rise pretty sharply over the past year, and that doesn't seem to be a problem. But here's something that everyone needs to consider. Why would the Fed cut interest rates by 50 basis points if the economy was so-called fine? Right? They shouldn't have to cut rates at all. They should be able to just leave rates where they are. But instead, they basically hit the panic button and did a big cut, saying, well, there's no promise that the next meeting we're going to have a cut or that we're going to cut by 50 basis points again. We just wanted to get off to a strong start to show everybody that we were serious about bringing rates down. And it's also surprising to me how confident Jerome Powell is in that they're going to be lowering inflation even further, even after such an aggressive rate cut. Because typically, when we see rates go down, it helps inflation go up. Just like supposedly, raising the interest rates was supposed to help inflation come down. And while it has come down, it hasn't gotten towards their goal yet, hasn't gotten to that 2% mark. So they're basically getting ahead of it, right? They're saying, well, it's almost down to 2%, so we're just going to start cutting now. Well, how come they didn't do that when inflation was on the rise? So we'll have to see what happens at the next meeting if they do a rate cut, or if it's by 25 or 50 basis points. We don't know what's going to happen. But I think it's safe to say that if they do a rate cut at all at the next meeting, whether it's 25 or 50 basis points, I would interpret that as, they're still continuing to hit the panic button. Because otherwise, once again, why would they be doing this, guys? Why would they be lowering rates at a time when the economy is supposedly strong? If the economy is strong, there would be no reason to lower them. And you got to understand that every time the Fed kicks off a rate lowering cycle with 50 basis points or more, that's always because we are in some sort of economic crisis. And this is going to look so bad for Jerome Powell, somebody who's supposedly trying to go out with a bang and have, a positive legacy on his hands. It's not going to happen once people look back on these press conferences of him basically lying about the economy. Then we get hit with one of the worst recessions this country's ever seen. Remember when I was talking about the price of gold also? Well, the fact that the price of gold still remains near record highs, even after this rate cut, indicates that probably inflation hasn't completely gone away and there's still a lot of economic concern out there. The world is buying gold because it's the only true way to protect wealth, guys. And this is not a sponsored video or anything. This is just something that I believe in and I've talked about for years here on the channel. Some people have said, well, what about Bitcoin? Bitcoin has, outperformed gold, especially this year and all of this. Like, listen, guys, I own Bitcoin. I do like Bitcoin, but I don't like the volatility of Bitcoin. My honest opinion on Bitcoin is I don't think anybody should buy Bitcoin unless you can afford to lose money. Meaning that however much you invest in it, expect to lose it all, because it has not been proven to really work as money just yet. It's still very new. It's still extremely volatile, as you can see with the massive price swings that we've seen recently. So even though I like it, I don't quite trust it yet. Whereas gold, on the other hand, is money, it's the only real money, and it's the only money that's ever been trusted throughout human history. So that's why I trust it. If it was good enough for our ancestors and everybody up until today, it's good enough for me. But hey, listen, if you think you can do better buying other things like Bitcoin or still investing in the stock market, whatever, go ahead and do that. I don't care. My goal when it comes to my own personal finances isn't getting as rich as possible. It's protecting what I already have, okay? And that's what gold does, if you ask me. And here's the other funny thing too, right? Like all of these economic numbers are trying to be painted with a positive brush, right? Like, well, unemployment's still very historically low, even though it's gone up a lot recently. You know, the GDP has been crushing it over the past couple of quarters, and also, you know, we're still not seeing a ton of people losing jobs, and we're still creating a lot of jobs. So these are all signs that things are going great, right? Well, once again, the question is, why did they cut by 50 basis points then? They should have just left it alone. Or do they know that we're already on the way down and that these numbers are going to continue to deteriorate throughout the rest of the year, and they're trying to get ahead of it? But the other thing is, not everybody's falling for this, including me, a lot of people who watch my channel, but also the bond market. Because after the Fed rate cut happened, we actually saw the long-term bond yields go up. Why is that? Maybe it's because investors of bonds believe that inflation is in fact not tamed and there's still going to be more problems with that moving forward. Most likely. They talked to an asset manager that has $160 billion in assets under management, and she says that we believe rates across the curve had come down too far, too fast. In fact, this asset manager thinks that the 10-year Treasury could end the year north of 4% and even at 4.25%. Well, as of me filming this video, it's already at 3.719%. And it's not just the 10-year that rose, you also had the 30-year Treasury rise as well after the Fed press conference yesterday. And the problem is the market talks about pricing in this whole soft landing, but when you're driving rates so low, that sounds a lot more like a recession. Everybody needs to understand that if you take anything away from this video, is there should be no reason to lower interest rates if everything is fine with the economy. So that's why I said many times in previous videos, always watch what the Fed does, not what they say, right? They say everything is fine, but they're acting as if it's not. That's the simplest way to understand and interpret what just happened. And you also have to understand that the Fed is lying to us and lying to themselves, saying they believe inflation is going to come back down to 2%, even while they are actively cutting interest rates. Well, that's not how it works, because when they cut interest rates, they're most likely to drive inflation back up at a time when it hasn't even reached the level they're looking for. Right now, the core inflation is sitting at 3%, guys. That's higher than the CPI numbers we just got last week. And that's usually the Fed's preferred measure of inflation. And it's at 3% right now. And so by knocking down these rates, they're very likely to push those numbers higher through the end of the year. And if they do, they may have to go back to raising interest rates again, which is going to make them look ridiculous. And I wonder if they'll even actually do it. Now, we also have some other things we can look at, and one of them is the leading indicators from the conference board, okay? And these leading indicators have been falling for 6 straight months. And when these leading indicators fall, it usually signals that we are heading into a recession, or at the very least, a period of low growth in the economy. In August, the leading indicator sank 0.2%, and in July, it went down 0.6%. And all this leading indicator is it's a composite of 10 forward-looking components designed to show whether the economy is in danger of falling into recession and where the economy is headed in the near term. The weaknesses in the economy, according to this index, are still the same, which are weak factory orders and the interest rate spread between 10-year Treasury yields and the federal funds rate. And here's another way that Jerome Powell basically got caught in a lie during his press conference, because in the most recent Beige Book, which is a report released by the Federal Reserve themselves, it showed that 2/3 of the Fed districts that they report on reported flat or declining activity in the economy. So in their own Beige Book, 2/3 of the country is reporting no growth or negative growth in terms of sales and business right now. So how can Jerome Powell come out and say that everything is good with the economy? That's a flat out lie. How come he didn't acknowledge this? Once again, guys, watch what they do. Don't listen to what they say. Economists are even looking at the most recent retail economic data, which shows concerns of us heading into slower economic times and basically a recession. So based on these current economic indicators, it's being predicted that the economy is going to lose momentum in the second half of this year as higher prices and elevated interest rates and mounting debt erode domestic demand. Basically meaning that people won't be able to buy as many goods and services, which will slow down the economy. And remember how we talked a little bit ago about the bond yields actually rising after the Fed rate cut? Well, you have to understand that mortgage rates and car loan rates and almost all borrowing rates are tied to the 10-year Treasury, okay? And since the 10-year Treasury has been going up, actually interest rates for mortgages and car loans have been going up since the Fed meeting as well. This is kind of the opposite of what a lot of people were expecting to happen. So anytime you hear your real estate agent or your mortgage broker or somebody like that tell you, oh, you know, the Fed just cut rates, mortgage rates are coming down. Well, actually, they're starting to go back up now. And now, don't get me wrong, they have been coming down a lot over the past couple of months. But now that they're starting to go back up, it could actually continue to go back up if these long-term bond yields continue to go up. So it's something we need to watch and keep an eye on for the future, and is yet just another thing that shows you how messed up this economy is right now. I mean, there's literally stories everywhere already trying to convince people to refinance because interest rates are coming down, and also trying to, you know, convince people to jump back into the housing market, which I'll make a full separate video on that, of course. But it's just like, when people don't pay attention to what's really going on, it's really easy to get duped and fall into a bad situation. And unfortunately, I think that's what's going to happen to a lot of people that just look at the headlines. Ooh, the Fed cut interest rates, or now's a great time to buy a house, and people are just going to do it based on that data alone, which is going to be one of the worst decisions they ever made, most likely. Now, I want to talk about one local issue here in California, which is gas prices. The other day I went to a gas station here and I saw this sign that says California lawmakers are driving up gas prices. So I took a picture of it and went to the website here to see what's going on. When you take a look at this graph right here, it shows you just how expensive California is compared to all the other most expensive states for getting gas. And California is by far the most expensive at an average of $4.60 a gallon right now. Washington State is the only one that even comes close at $4.23 a gallon. Everywhere else is at least under $4 a gallon. So it's obviously very expensive to fill up your car here. But as of August 12th of this year, California drivers now pay on average $1.16 more for a gallon of gas than the national average, and $1.22 of each gallon of gas that you purchase here goes towards local taxes, fees, and environmental programs. And of course, this is all thanks to state lawmakers, and their future plans are to drive gas prices even higher with increased environmental fees in the coming years. Also, you had California's gas tax increase in July of this year, and taxes and fees are set to go up even more, including substantial increases to the cap and trade program and low carbon fuel standard that they have here in California. And yet this, even with all the electric vehicles you see around here, still 95% of people in California drive gas-powered vehicles. So this is massively ripping off people that live here in California, even if you drive an electric car too, guys, because don't forget, still the lion's share of the electricity is still produced by natural gas and oil. I mean, look, PG&E here in California, they just raised their rates for the 4th time in 1 year. You know, that's arguably even worse than what's happening with gasoline here. But the reason I wanted to share this is because they actually had something on the web page here where you can use this tool to send a pre-drafted letter to your local legislator to encourage them to support common sense energy policies and, you know, make fair laws for everybody who lives here in California. And even though I don't live here, I visit here and I'm impacted by this while I'm here. So if you do live here, you should definitely check out this link, guys. I'll have it down in the description below. Always in my descriptions, I share all the stories I talk about. So when you scroll down in the description and you see articles mentioned in this video, that's where you'll find all the links, including this one I'm talking about right here, if you want to send that letter to your local legislators. Can't promise it's going to do anything, but I think it's worth a shot when you're paying close to $5 a gallon here and counting. Some places it's even more. I mean, the prices swing a lot depending on where you live in California. And for anybody who stuck with me all the way up to the end, today I walked through Bell Marin Keys up here in Novato. And I came up here once before just to drive through the area and look at open houses. And it's this huge neighborhood by the water, and seems like a pretty peaceful place, and it was. So if you enjoyed this video, make sure you're subscribed to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.